Since the year 2000, the average American renter's wage has grown by roughly 50%. Over that same stretch, rent has grown by nearly double that. And if you think that gap is just landlords being greedy, that's the story you're supposed to believe. Because the real story isn't that your landlord raised the rent, it's that your rent was never designed to just cover a roof. It was designed to be the return leg of a bet, and you've been funding both sides of it without ever being told you were playing. To some people, renting is simple. You pay for shelter, the landlord pays for the building, and everybody walks away even. That's the story you hear from every finance guru who's never actually run the numbers. The same people who'll tell you to just skip the daily coffee and somehow that closes a gap measured in tens of thousands of dollars. But to others, and I'm one of them, a lease isn't a service you're buying, it's a financial instrument, and you're on the losing end of it by design. By the end of this video, I think you'll be on this side too, because there's one question almost nobody asks about their own rent check, and once you ask it, you can't unsee the answer. If a landlord is taking on all the risk of owning property, why does the tenant end up the one who's broke? Let's start with what a lease actually is once you strip away the framing. When you sign a lease, you're agreeing to pay a fixed amount every month for the right to occupy a space someone else owns. That part everyone understands. What almost nobody understands is what that monthly check is actually doing on the other side of the transaction. If the property has a mortgage, and most rental property does, your rent is first used to cover the interest and the principal on that loan. Every payment you make is quietly retiring somebody else's debt. Then, whatever's left over after the mortgage, the taxes, the insurance, and the maintenance, that's pure profit for the owner. And on top of that, the property itself is very likely appreciating in value the entire time you're living in it. So the landlord isn't just collecting a check. They're collecting a check that pays down a loan, builds equity, and rides an appreciating asset. And the tenant is the one financing all three of those outcomes at once. That's not a service fee. That's a leveraged position, and you're the one supplying the leverage. This is where most people push back and say, sure, but the landlord took the risk. They put down the down payment, they signed for the mortgage, they're the one who's exposed if the market crashes. And that's true on paper, but here's the part that gets left out. The tenant absorbs the downside risk too, just in a different form. If the market crashes, the landlord can sell, refinance, or simply wait it out while someone else's rent check keeps the loan current. The tenant doesn't get any of those options. If rent goes up because the landlord's costs went up, the tenant pays it too. If rent goes up because the market is hot and the landlord wants to capture more of it, the tenant pays that too. There's no version of this trade where the landlord's risk and the tenant's risk are actually symmetrical. One side has an exit, the other side has a bill, and when the lease ends, the tenant walks away with nothing to show for years of payments except a rental history, while the landlord walks away with a little more equity than they started with, funded entirely by someone else's monthly income. And once you see the mechanism, you start noticing it isn't some accident of a few greedy property owners. It's a pattern that scaled up dramatically, and it scaled up right after the moment you'd least expect it. Go back to 2008. The housing crash wiped out trillions of dollars in home equity, and millions of families lost their homes to foreclosure. For most people, that was the end of the story, the worst chapter in modern housing history. But for a handful of investors, it was the opening bell. Private equity firms and institutional investors looked at a market flooded with cheap, foreclosed single-family homes and did something nobody expected at that scale. They started buying them up by the tens of thousands, not to flip them, but to rent them out. Companies like Invitation Homes and American Homes for Rent built entire portfolios out of the wreckage of the crash, often financed by the very Wall Street firms that helped cause it. Blackstone alone spent billions buying foreclosed homes across the country, turning what used to be individually owned starter homes into institutionally managed rental units. The families who lost those homes in the crash became, in a lot of cases, the exact same people paying rent on them a few years later. The house didn't change hands to build wealth for a new family. It changed hands to build yield for a fund. And once those funds proved the model worked, they didn't stop buying. They kept scaling quarter after quarter, turning starter homes that used to be a family's first rung on the ownership ladder into permanent inventory on an institutional balance sheet. That was the first version of the trade going institutional, but it didn't stop there, because once Wall Street realized single-family rentals could be packaged and scaled like any other asset class, the next step was obvious: turn the whole thing into a security. Real estate investment REITs, or REITs, let ordinary investors buy a slice of thousands of
of rental units at once, collecting a portion of the rent as a dividend without ever owning a single doorknob, which means somewhere out there, when your rent check clears, a piece of it might be landing in someone's retirement account 3 states away, someone who has never seen your apartment and never will. The tenant became the engine, the rent became the yield, and the property became just the vehicle carrying it. But the part of this story that should actually worry you isn't the ownership, it's what happened once these landlords realized they didn't even need to guess what to charge anymore. For most of history, setting rent was a judgment call. A landlord looked at the neighborhood, the comps, the vacancy rate, and picked a number. That process, slow and imperfect as it was, at least meant landlords were competing against each other for tenants. But starting in the 2010s, a company called RealPage built software that changed that entirely. Landlords feed in their internal data, occupancy, lease terms, rent rolls, and RealPage's algorithm spits back a recommended price, pulling from a shared pool of data contributed by competing landlords in the same market. In 2022, an investigation by ProPublica found that in some cities, the majority of large landlords were using this exact same software to price their units. And in 2024, the Department of Justice, along with a group of state attorneys general, sued RealPage, alleging the software allowed landlords who were supposed to be competing with each other to effectively coordinate on price instead. Landlords weren't guessing what the market would bear anymore. They were being told what the market would bear by a system built on data from the landlords right down the street, and in some documented cases, the software reportedly held units vacant rather than lowering rent because keeping the market price high across the whole portfolio was worth more than filling one apartment. That's not a free market setting a price through competition, that's a shared algorithm removing the competition and calling the result a market rate. And pricing isn't even where it stops. Once a landlord is managing rental units at institutional scale, the lease itself stops being the only place they can extract value. Application fees, amenity fees, so-called convenience fees just to pay rent online, utility administration fees on top of the actual utility bill. Individually, each one looks small enough to be not worth fighting over, which is exactly the point. Stack them across tens of thousands of units, and they become their own profit center, separate from the rent itself. The Federal Commerce Commission has specifically flagged this practice in the rental housing industry, calling out junk fees that get added late in the leasing process after a tenant has already committed emotionally and logistically to a unit, when walking away means starting the entire apartment search over from scratch. It's the same dynamic as everywhere else in the economy, an unavoidable fee dressed up as a convenience, except here the tenant has almost no leverage to refuse it, because the alternative is not having a place to live. So here's where the story lands. A lease funds a mortgage payment you'll never see the deed for. The equity it builds gets collected by an owner who may not even manage the building themselves, and the price you're quoted increasingly isn't coming from a landlord sizing up the market, it's coming from software trained on the very landlords it's supposed to be helping tenants against. Before we go further, a word on how this actually connects to something you can control, instead of just something happening to you. If you're currently renting and telling yourself the plan is just to save aggressively until you can buy, it's worth understanding why that plan keeps sliding out of reach. It's not because you're bad with money, it's because the gap between rent growth and wage growth means the size of the down payment you're chasing keeps growing faster than your ability to save for it. The system isn't just charging you more, it's actively widening the finish line while you run toward it, and no amount of cutting out coffee closes a gap that's expanding faster than your paycheck. And this is exactly why understanding your real hourly wage after housing costs matters more than any budgeting app ever will. Half of all renters in America are now considered cost-burdened, meaning they spend more than 30% of their income on rent alone, according to Harvard's Joint Center for Housing Studies. That's not a personal failure showing up in that number. That's the mechanism working exactly as designed at scale across tens of millions of households at once. And it's worth sitting with what that actually means. Half of the renters in this country are working jobs where a third or more of every single paycheck is gone before groceries, before gas, before anything else. And it happens quietly enough that most of them think it's just their own budgeting that's the problem. Think about what that number actually does to every other financial decision in your life. It's not just that you have less left over, it's that the margin for error disappears entirely. One slow month at work, one car repair, one medical bill, and there's no cushion left to absorb it, because a third of your income was already already spoken for before you even got paid. That's not a coincidence sitting next to the trend of rising institutional ownership and algorithmic pricing. It's the direct output of it. The tighter the pricing gets coordinated, the less slack renters have, and the less slack renters have, the more predictable and durable that rental income becomes for the owner on the other side of the lease. Your financial fragility isn't a side effect of the system. For the people holding the asset, it's closer to a feature, because a tenant with no leverage and no alternative is a tenant who renews.
So let's go back to the question from the start of this video. If a landlord is taking on all the risk of owning property, why does the tenant end up the one who's broke? We can finally answer it. It's because the risk was never actually split evenly in the first place. The landlord's downside is protected by exit options the tenant never gets. The upside, the equity, the appreciation, the yield, all of it flows in one direction. And now, increasingly, even the price setting itself has been pulled out of a competitive market and handed to a shared algorithm designed to protect that flow. None of this means renting is always a mistake, or that every landlord is running some kind of scheme. Plenty of small landlords are just people trying to cover a mortgage on a single property, showing up to fix a leaking faucet themselves on a Saturday. And for a lot of renters, right now, renting is still the only realistic option available to them given where they live and what they earn. But the trend line across the industry as a whole is unmistakable. Ownership is consolidating into fewer, larger institutional hands. The pricing is coordinating through shared software instead of competing through an open market. And the tenant is increasingly the only party left in the transaction with no exit, no equity, and no say in how the number gets set. The next time your rent goes up and the renewal notice says something vague about market conditions, you'll know what that phrase is actually doing. It's not describing a market. In a lot of cities now, it's describing a shared spreadsheet built from data your own landlord handed over, priced by a system designed to make sure nobody in the building undercuts anybody else. If you want to actually understand the mechanics behind the bills you're paying instead of just absorbing them, hit subscribe, because the goal here was never to make you angrier about your rent. It was to make sure you're not the only person in the transaction who doesn't understand what's actually happening every time you pay it.